Welcome to an economic update, third quarter 2021. My name is Mike Aguilar. I teach economics and finance at Duke University and UNC Chapel Hill. I'm also the Chief Investment Officer at Cardinal Retirement Planning. I put together this talk for you in conjunction with Professor Soquist, a friend of mine at UNCW. So what are we going to talk about? We're going to talk about the U.S. recovery from COVID and maybe where the economy is going. And I structured it for a non-technical audience. To the extent I use any jargon, I'll do my best to define as we go. All right, let me give you a preview, 3 pieces. Firstly, the recession, it's over. Officially speaking, it's over. But there's more progress to go. 2, inflation that you might be seeing now, I think it's going to last a little bit longer than many people expect. And that's because of a confluence of forces, Federal Reserve policy and what's called supply protection. I'll detail that later. And I think that's going to combine to mute what we've seen, a decades-long disinflation. But that doesn't mean that I see going back to the 1970-style double-digit inflation. Third piece of the preview. You might have heard some people talking about a roaring 20s. I think that would be great, but I'm not quite as optimistic. I'm looking for more of a quote-unquote purring 20s. Fiscal stimulus is going to drip out. COVID uncertainty, supply constraints that might linger, all coalescing around a slower but drawn-out expansion. Now, I want to talk about 5 things, 5 steps: labor, inflation, interest, exchange rates, and output. And each one, I'll try to cast it in terms of questions you might be asking, all right? So first one, has the labor market recovered from the COVID recession? Pretty good. Not great, but pretty good. This is the unemployment rate. Right now, the unemployment rate is 5.2% in the United States. That's the blue line. And it's charted back to the 1940s. Each gray bar indicates a recession. The wider the bar, the longer the recession. And we see dramatic spikes. We saw a dramatic spike up to nearly 15% during COVID and a dramatic spike down. It actually looks very different than the other recessions. And I'll talk more about how this COVID recession truly has been different. So we've come back down quite a bit, but are we good? One of the ways that we can determine whether or not there's more room to go is with regard to the red line. See, the red line is the natural rate of unemployment, sometimes called non-cyclical. The idea is, what should the unemployment rate be given the amount of people we have, their skill sets, the amount of infrastructure? And whenever you see blue above red, that means there's more to go. So that's the state we're in for the unemployment. Now, employment. COVID was reducing the growth of jobs. It started to actually amplify again once we got into 2021, and we saw some nice growth. We had a setback just recently in the summer with the Delta variant. So that's discouraging. Another key piece of the labor market is the labor force. It's a lifeblood of the economy. How many people do we have getting out there and working? This is the labor force participation rate, people who are working or looking for work. 25 to 54-year-olds back in the 90s, it was around 84%. Structural decline started to turn in 2015. COVID hits and dramatic decline, well below 80. Now, it's beginning to recover, which is great. We're only at 81.8. 2019, right before COVID, it was at 83. So we have more room to go just to get back to where we were pre-COVID, let alone to where we were back in the 90s. So we have more room to go. It hasn't recovered fully, but good progress. Now, why are companies having so much trouble finding workers? You might have seen there's help wanted signs everywhere, which you wouldn't think would be the case amid a recession. And maybe you've seen even some of these new policies that firms are taking on, not only paying more, but all sorts of in-kind stuff. Amazon is paying college tuition for its workers. This is indicative of what's called a tight labor market. So one of the ways economists measure whether or not a labor market is tight or loose is with a ratio. Unemployed divided by job openings. If that number is like 2, okay, that means there's 2 people unemployed for every job opening. The bigger that number, which is typically the case in recessions, the easier it is for an employer to go out and find somebody to hire. And you saw it jumped up to almost 7%. in the Great Recession of 2008, a loose labor market. It declined afterwards, as it always does. It took some time, and then it went below 1. Fewer unemployed people for every job opening. And that was indicative of a tight labor market. That's the situation we were in pre-COVID. COVID upended that as well. Spike, recession, and it's actually been declining so much so that we're tight again. It's odd to think about a tight labor market so quickly after recession, when people feel like we're in a recession. So why is that? There's a myriad potential reasons. Some of them. Retirement, skills, satisfaction, stimulus. Let me give you a sneak peek of a few of these. Retirement rates have been rising. And if you look towards the end in 2020, that black line, which is the percent of the population retired, actually accelerated. So that's fewer people active in the labor force. An interesting idea was the notion of unretirement. Very often what happens is as we're on the onset of a recession, people are thinking about retiring, and maybe they'll take early retirement, maybe they do retire, and then when the smoke clears and the recession's over, some of those who just retired, they come back. They start working again. They add more to the labor force. That's not happening. Not to the same extent during this recession. Fewer people. Before COVID, there were structural mismatches, which means I'm a company, I need people with a certain skill set. I can't find people with that skill set. That was there before COVID. COVID exacerbated it. Another potential reason, policy, both from the company side as well as the Biden administration, mandating vaccines. We know some people aren't happy to do that. And as a result, they don't want to return to work. This is a poll conducted by the Dallas Fed, looking at the percent of people willing to return to their previous job. Look at the red bar. No, I'm not willing to return to my previous job. 20% in July of 2020, 28% or so in December of 2020, over 30% in April 2021, not wanting to return to their job. So why are they having so much trouble finding workers? Corporate and fiscal policy, as well as the preference for work from home, WFH, work from home, because of this dissatisfaction. I mentioned before wages are rising, but for many people it doesn't feel like it. Wages are indeed rising. This is the average hourly earnings. And the blue line indicates that those dollars per hour are going up. There was a spike during the COVID recession, which is unusual, by the way, and then it's hit this trajectory, so they are rising. There's no debate about that on average. And when you dissect by type of worker, let's pull out the low-wage workers. They were hit hard, service workers and such, leisure, hospitality. But that green line is making progress. The green is the low-wage workers. The blue are the average workers. The green is above the blue. So they're getting paid a little bit more. Why aren't they feeling like it? One of the culprits is cost of living. So in a typical year, back since 1995, wages go up by about 3%. Cost of living goes up 2.2%. Which means that your paycheck can buy more, 0.8% more. What's been going on lately? Wages have been going up 3.8%, cost of living by more, 5.3%, which means your paycheck can buy less, 1.5% less. So sure, my paycheck is growing, but I can't buy as much, so I don't feel like it. Also, that job dissatisfaction. There are surveys from the Conference Board suggesting that overall job satisfaction was rising heading into 2020, and then maybe you've heard these stories, a year of remote work, and people are just fed up. So yes, I'm getting paid more. Maybe I'm getting these fringe benefits, but I just can't take it anymore. Maybe that's why. Maybe these are reasons why, even though wages are rising, it really doesn't feel like it. That's part one of 5 pieces. Stick with me. Part 2, inflation. Car prices, outrageous. Up. For used cars, 44%. New cars, 7%. Why? Let me just say, in where I live in North Carolina, used cars, it's perhaps the most difficult in the country to get a used car, right? Forget about just the pricing, getting access to it. Why would that be? I'm an economist. I like to think in terms of supply and demand. Many forces drive each. Let me just talk about a couple. First, supply side. One of the key inputs of cars, semiconductors, these little computer chips. And there's pieces into that. ASML is one of the companies that has a stranglehold on one of the pieces that go onto those computer chips. They can't keep up with business. They're a relatively small firm, but there's tremendous demand. What about the companies that actually make those computer chips? Taiwan Semiconductor is one of them. They've had COVID shutdowns like many other firms, but one thing that's unusual, maybe you haven't heard of, they had a drought, water shortage. And as a result, one of the key inputs, water, into the production process was gone. That's a supply shock. Less supply. Keep that in mind. Less supply. What's going to happen to prices? Demand side. People aren't taking as much public transportation, so that means they probably need more cars. And something unusual, rental car agencies actually dumped a lot of their fleets at the outset of COVID because leisure and hospitality was terrible. Now they're trying to get back and they have more demand for cars to replenish their stock. And so you have a confluence of forces. The downward sloping line is demand. The upward sloping line is supply. And both of those have been pushed. Returning to work without public transport, restocking rental car fleets, pushing demand. At the same time, COVID shutdowns, not enough chips, restricting supply. You know what that adds to? Higher prices. So, chip shortage, high demand, car prices outrageous. Is this going to permeate to everything? How long will this continue? Well, it does turn out that other prices, not just autos, have been rising. Food and beverage in the red line. Energy in the green line. An index of lots of other stuff in the purple line. All going up. All going up. The Federal Reserve, our central bank, says that this spike in inflation that we're seeing is transitory, which has an amorphous meaning, but essentially it's not going to last very long. It's going to last a few months, and then it will pass. So I want to see if we can frame an argument for or against that. And I encourage you to sort of weigh the evidence. This isn't all the evidence. This is some elements of it. How many categories are rising? Is there historical precedent? Labor scarcity, low wages, fiscal stimulus, pipeline pressures. Inflation is transitory or not transitory? Let's see if we can do a balancing act. So let me dig into a couple of these, all right? One, those folks who say that this is transitory are pointing to the fact that it's not widespread. It's really just mainly focused in a couple of key categories. One, autos, which we just talked about. Two, anything that's leisure related, airfares, hotels. And as we recover and COVID dissipates, those would dissipate as well. Argument for transitory. Okay, so there's arguments against transitory as well. Think about if you were a manufacturer, right? And you have inputs. You have to buy those inputs from a vendor. You call up the vendor. They don't have the part readily available, so you have to wait. There's a lead time. Well, those lead times are rising. That's what you see in that light blue line. And why is that? Supply chains are just congested. And as a result, as a manufacturer, if I want to get that part, I have to pay more. That's in that bar, the dark blue bar. So the vendors are constrained, supply chains are constrained, and we're seeing inflationary pressures that may not be transitory, that may last a while. There's historical precedent for inflationary spikes lasting a while. The blue line is a measure of consumer price inflation. And each of these arrows are indicating that there's a cycle to these spikes, and the cycles usually last around 3 to 4 years. We're at the early innings of that. Take a look at this graph. The flat axis at the bottom, horizontal, tells me how many months since the beginning of the spike. The up and down, the vertical axis, tells me how big was the spike. I have a few of them on there, not all of them, but a few of them for comparative purposes. I highlighted our current one. Now, you don't have to worry about the numbers, but I do want you to look at how many months it goes and how high up it goes. The blue line, the dark, dark blue line. We're relatively young, and we're relatively muted compared to typical inflationary episodes. Granted, this may not be typical, but if it follows any type of historical precedent, we have more room to run in both directions. Major forecasters are expecting that to continue somewhere above 2%. And the 2%, and the reason why we point that out, Federal Reserve targets 2. So we always use that as a benchmark, and they're expecting that to be above 2% for some time. Companies are stockpiling. Popeyes is stockpiling chicken, or at least they were. Why are they doing that? They might see something. Rent is going up, and it has been going up. Has not yet shown up in the official price indicators. So even if everything stays steady, we're going to have a wave of rental price increases coming and hitting our official indicators soon. So when I'm weighing the transitory or not debate, I'm leaning more towards this not being transitory. I think this can last a while. Between the stimulus, the fact that we can't find enough workers, all these pipeline pressures, the typical historical precedent, I think this is going to last a little bit longer than some people expect. But does that mean we're going back to the 70s? Double-digit inflation prompted by oil prices. Again, the financial markets have been talking about this, and they've been worried about this, and asset prices have reflected that. Can we debate pro or con? Inflation will remain high. Inflation will go back to a sub 2%. Lots of forces. Here's a few key ones. Federal Reserve, Amazon effect, debt, potential growth, and supply chains. Once more, I want you to come to a conclusion on your own, but let me give you some information, all right? Debt. This is federal debt held by the public as a percent of the size of the economy. And you can just see from the line, projected to rise, rise, rise. It's not all because of COVID, okay? COVID has exacerbated, but this has been a structural impasse. Now, could that lead to inflation? Potentially. What it could do is spark more demand, which sparks higher prices. It could mean that the more debt which is issued gets monetized by the Fed, meaning they're buying it, which leads to devaluing of the dollar and higher prices. All this is possible. So that's one argument for potentially higher prices. Oil was a key culprit back in the 70s, and what are the projections for a long-term basis? Nothing as extreme as what we saw back then. Forecasters in general aren't expecting a repeat of the 70s. I'll tell you where I fall on this, okay? So there was a decline in the rate of inflation. We call that disinflation. For many decades, I think there was three key forces. One was the fact that the potential of the economy, our potential growth rate was slowing. So slower potential, slower economic activity, slower inflation. One. Two, Amazon effect. Digitization. You can buy anything on your phone at any point, increases competition, pushes prices down. Three, just-in-time inventory. Global supply chains. Manufactured all throughout the world, coming together, that reduces prices. COVID disrupted that, potentially upended that last piece. The other two, slower growth, Amazon effect, they're still in play. But global supply chains, what's going on now is that some manufacturers are recognizing the fact that they need to protect their supply chain. They need to bolster inventories. And bolstering inventories not just to where they were, but above that. That might increase costs. That might put upward pressure on inflation. Coupled with easier Fed and maybe rising debt, I'm actually leaning towards the camp of inflation remaining higher than the 2%. Not 1970 style double dip. Doesn't mean we won't have spikes up and down, but leaning towards something which is a higher rate of inflation than what we have been seeing. So are we headed for a repeat of the 70s? No, but probably stabilizing higher than previously. Remember, I said there was 5 key pieces. I want to get to the third now. Interest rates cast as questions you might be asking. Why are interest rates so low? Maybe you've noticed if you go for a housing, car loan, historically low rates of financing. Lots of forces that could be driving this. One of the main culprits, in my opinion, is the Federal Reserve buying assets. Now, when the Federal Reserve buys assets, usually bonds, they take money out of their vault, quote unquote. They make money, quote unquote. They actually do it through a fractional reserve system. And what that does is it increases the money supply. The blue line is the amount of money in the economy. You saw it spike in 2010, 2009 in fact, amid the Great Recession. It started to dissipate, and then it spiked again amid COVID. These are emergency measures they're taking to fight this recession, to fight this illness. The more this money they put out there, the more pressure there is on interest rates to fall. I think they were one of the key culprits, not the only, but one of the key culprits as to why we're seeing such low interest rates. So are they going to reverse it? Are they ever going to raise interest rates? Think why the Fed does this in the first place. More money, lower rates, more spending. Sure, that might cause inflation, but they're not too worried about that right now. Job growth. They want to stimulate economic activity and get jobs going. And right now, it appears as though more among the Committee on the Federal Reserve, more members, are focused on jobs than inflation. Their duty is to balance those two. Some on the board are beginning to express more and more fears of inflation percolating, and they want to take proactive measures. So where do they land on this? We can actually peek in and get a sense of what they might do. What you have here on that horizontal, the bottom axis, are years, 2021, 22, 23, and what they call longer run. Each dot is a vote from somebody in the Federal Reserve as to where they want to put interest rates. You can see all the dots for 2021 are really low. That's the low interest rates that we were just talking about. 2022, still really low, all the dots. By 23, there's some disagreement, some dispersion. Interest rates might start to rise. And eventually, whatever long run is, get back to around the 2 or 2.5%. So this is a sneak peek into what they're thinking. So will the Fed ever raise rates? Yes, but probably not anytime soon. Let's keep going around the circle. Exchange rates. Here I want you to think globally. Two key questions. Is the global economy recovering like the U.S.? We interact with the global economy. We're not closed and insular, so it's important to know how healthy our neighbors are. And the dollar is the medium of exchange between these countries. Is it worthless now? Well, what's driven our rapid recovery and hopefully potentially expansion is a combination of great progress on the COVID vaccinations and stimulus, fiscal and monetary. Not quite as lucky globally. Some countries have made more progress on vaccinations than others. Some have had the political will for more fiscal or monetary stimulus than others. There's a tension between those. En masse, we're not seeing the type of recovery globally that we are seeing in the United States. The dollar spiked amid COVID right at the outset. The blue line here is the strength of the dollar. Higher or stronger. And that's not surprising. When there's times of stress, people run to the things of safety. Gold, 10-year treasury, and very often the dollar. Now, when we got our foothold in and things were beginning to settle down, the dollar actually started to decline in strength and actually a little bit lower than where it was, but it's been stable. So on net, is the global economy recovering the same as the U.S.? No, but it's growing. Is the dollar worthless? Worth less, but not worthless. Last piece of the puzzle, number 5, output. A couple of questions for you. One, is the recession over? Yeah, it's over. April 2020. There's an official arbiter, NBER, National Bureau of Economic Research. They said that it was over, even though for many people it may not feel like that. It was one of the shortest on record, and I'll show that to you in a few ways. Firstly, look at the blue line. That's the size of the economy. And the gray shaded region, just to remind you, indicates a recession. The wider the bar, the longer the recession. Look at the length of the bar, 2008. Look at the length, or how narrow the bar is today. Dramatically different. Look at the blue line dipping down like a bowl and coming back up in the 2008 crisis, and look at the check mark, the big spike. Dramatically different. The red line tells me what we could potentially do. Can we live up to our potential, given our labor force, the number of people, the productivity, how efficient they are in working, our capital stock, how many machines we have. When you see that blue line less than the red, that means that we have more to go. So we're getting there, but we're not quite there yet. To see that in a different perspective, take a look at recessions. Now, the bottom axis, the horizontal one, is the number of quarters since the beginning of a recession. The vertical axis, up and down, tells me how big was the recession and recovery. I have several on there going back to 1948. I highlighted 2, the Great Financial Crisis, Great Recession of 2007 and 8, and today. You can see the green line. It kicks down and then slowly recovers. It took quite some time. Red line, a dramatic dip. I mean, it's a stark contrast. Not just in the magnitude, but the rapidity. So this time truly was different for that recession as well as the recovery. Now I want to look forward to beyond recovery to expansion. What comes next? Even though the recession's over, are we going into a roaring 20s? A time, a decade of ebullient, fast-paced, frenetic growth? I want you to be able to weigh the case for yourself. There's many different arguments on both sides. Let me give you a few of the factors. Infrastructure plans, capital stock, labor force growth and productivity, COVID supply constraints. Are we going to a roaring 20s or what I call a purring 20s, something which is slower, longer-lived? I'll look at a few of these here. First one I love looking at is from the Congressional Budget Office, shows our potential. Each bar gives me the total amount of potential, and it's broken up into labor force and its productivity. It's been declining for several decades for a whole host of factors. Our capital stock, our demographics, and it's projected to continue to decline. That's an argument for something where it's not roaring, but rather purring. Now, most recently, we are seeing what's called capital deepening, where we have businesses going out, buying new machines, buying new tools, building new factories. And that's great. What I'm concerned about, though, is whether or not this recent upturn in this is cyclical or structural. Something which is, going to just last a few quarters, or something which is going to continue over a long period of time. I'll tell you where I land on this. I'm leaning more towards the purring 20s. The case for roaring, really, I think the two main arguments are that capital is deepening. What we're seeing right now for new machines and tools is not ephemeral. That's going to last. And then the infrastructure plan from the Biden administration is going to be a huge progenitor towards a roaring 20s. Those are two arguments for that. Now, personally, I think that infrastructure plan is not going to pop. It's designed to actually drip out through time. So I put that in the purring 20s argument, in fact. Labor force growth is continuing to decline. Productivity is continuing to decline. And what concerns me is that the natural jump that you get out of the beginning of an expansion has a restrictor plate on top of it. That is COVID uncertainty and supply constraints. As a result, I see purring 20s rather than roaring 20s. Now, within output, there's two elements that I think are near and dear to our hearts. And I want to talk about those before we go. Firstly, consumer. Secondly, housing. How has COVID impacted the consumer? There was actually a change in consumer behavior pre-COVID where people are buying less stuff and more experiences, travel and such. COVID upended that. Everything fell. Consumer goods, services, right, among COVID. And they started to increase again. Services, not as much. Experiences, not back to where we were pre-COVID. But durable goods, like stuff you get on Amazon, Home Depot, Lowe's, dramatic. Not only back to where we were, but well beyond that. So the consumer has really changed their behavior. But one question, and I want you to think about, is how could a consumer afford this, not just to where we were, but beyond that, amid a recession? It's not just stealing from services and giving to durable. It's something stronger than that, and it has a large part to do with what happened with support and policy. Loans, okay? Think about what would happen to loans, borrowers, amid a recession, right? They laid off, no job, no income, or less income. As a result, I default. Or less income, I'm delinquent on a loan. That didn't happen, at least not to the same extent. Look at the red line, student loans. Percent delinquent fell dramatically. Why is that? Biden administration, loan moratoria. So how can the consumer change their behavior and afford this? We have tremendous fiscal support. Next, housing. Are we in a bubble? Get that a lot. Headlines all over the place, screaming at you. Housing prices are up. Housing is sitting on the market for a record short period of time. And indeed, housing prices have skyrocketed, up 18%. And that's just on average. Construction prices up dramatically, feeding into new home prices. This is fodder for people claiming that we're in a bubble. But higher prices don't necessarily mean a bubble. When you hear bubble, I want you to think artificial. It's fake, not fundamental. Will the acceleration of housing prices start to slow? I think most definitely. Will housing prices actually fall? Potentially, but not like 2008 if they do. 2007 and 2008, artificial. 2020, fundamental demand for housing as we work from home amid COVID. Structural changes in offices and location. So another bubble in housing? Not like 2008. Let me summarize for you, okay? 3 key pieces again. 1, recession is over shortest on record, more room to grow, especially labor. 2, inflation is likely to persist a little bit longer than many expect. Federal Reserve policies and supply protection are going to mute this decades-long disinflation, but I don't see another double-digit 1970s style. And the third point I want to leave you with is I'm seeing more of a purring rather than roaring 20s. The design of fiscal stimulus, the uncertainty over COVID, the supply constraints are all coalescing around a more slow, drawn-out expansion. Hope that helps. Thanks for tuning in.